Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the Treasury yield curve and recessions. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below. And if you sign up, you of course get access to charts like the one that you see here, and some of the ones that we'll talk about as well in this video. Now, the yield curve is something that we've gone over a number of times, but in this video, I want to pay a little bit more closer attention to some of the details of what's actually going on, because it's easy to gloss over it in videos specifically about the equity market or if we're tying it into crypto. But in this video, I just want to look very, very closely at the yield curve and the implications of the movements going on right now. Okay? So this is what the yield curve looks like right now. And if you're unfamiliar with the yield curve, you should know that the way that it looks right now is not how it normally looks. And fundamentally, we can understand why, right? The short end of the curve, so like 1 month, 2 months, 3 months, you're actually getting higher annualized yields than you are at the long end of the curve. Again, these are annualized yields. So, for holding it 1 month, it would be, 5.5% annualized, right? Not in that single month, just to be clear. But fundamentally, in normal times, in healthy economic times, you would expect that longer dated treasuries, like 5 years, would provide a higher yield than some of the shorter dated treasuries, like 1 month and 2 months. It's like when you let's imagine you're sort of in the cryptoverse and you're locking something up for a certain amount of time, right? The longer you lock it up for, the higher yield you would ultimately expect to get, because you're essentially tying your cash up for longer. Therefore, the idea is, you want a higher rate. You want a higher rate to attract you to locking your money up for a longer period of time. And normally, this is what you would expect, right? This is what the yield curve normally looks like. This is what it looked like in 2016. This is 2017 and 2018. Perhaps a useful exercise would be to go back to 1990 and just play it for you so you can see, and you can see it's going across the years up here. Watch what happens when we get close to the 2001 recession. Inversion, uninversion. Watch what happens when we get close to the 2007 recession. Inversion, uninversion, recession, right? And then pretty normal looking yield curve for the better part of a decade. And then over here, we of course got the 2020 recession, very quick inversion, uninversion. And now again, we are looking at an inverted yield curve, okay? So the inverted yield curve right now is not something that we would see in normal times, right? When the economy is healthy, this is not something you would normally see. Now, it might feel like this is the new normal because it's been inverted for a while, but in the grand scheme of history, or at least the history that we have here, looking at the yield curve going back to 1990, we didn't really see a lot of time where the yield curve was actually inverted, right? It looks like this most of the time, where it's, the longer dated treasuries provide a higher yield. So then the reason why we talk about this, the yield curve, is because historically it is often a predictor of recessions, right? It has a fairly good track record. Maybe not perfect, but has a fairly good track record. And what it tells you, essentially, is when we have an inverted yield curve, it tells you, or at least my interpretation, right, is that the economy is sick in some way. It doesn't tell you exactly what's going to potentially kick off a recession, but it tells you it's sick. And, if we keep going along this route long enough, it will likely push us into a recession, just like it did, last business cycle and the business cycle before that and the business cycle before that, and so on and so forth. Okay? So what's interesting, though, is if you rewind the clock just a little bit, you will notice a fundamental change. So look at the short term, about 5.5% or so. Look at the longer term. You're looking at about 4.7% for, say, the 10-year. The 30-year is about 4.9%. But look where it was back in June. The short end of the curve is relatively unchanged, right? Still around that 5.5%. But the long end of the curve was all the way down here at 3.5%. So over the last few months, the long end of the curve has shifted up considerably from about 3.5% to over 4.5%, right? So because of this, because the short end of the curve hasn't really adjusted anywhere, right? It's still sitting at about 5.5%, which makes sense because that is that is essentially the Fed funds rate, right? The rate that the Fed has interest rate, the Fed funds rate out right now is 5.5%. So it makes sense for the short end of the curve to be around that level, unless the markets are expecting the Fed to really start to cut or to increase anytime soon. But the market is not currently expecting that, right? The market, as of right now, expects the Fed to sort of hold at these levels for at least a few months, and that's why the short end of the curve is more or less just at the Fed funds target rate. But because of the fact that the long end of the curve has moved up, the spread between the short end of the curve and the long end of the curve has narrowed, right? So let's take the 3-month and the 10-year. I think two of the more popular ones to look at are the 3-month and the 10-year spread and the 2-year and the 10-year spread. Some people prefer one over the other. I tend to prefer the 3-month and the 10-year over the 2-year and the 10-year. I think the 3-month 10-year has a bit better, a bit better track record, maybe a little bit more predictive over the 2-year and the 10-year. But that's just my own personal preference. You could come up with reasons perhaps why the 2-year, 10-year is better. But when you look at the spread between the 3-month and the 10-year, this is what it looks like. And this goes all the way back to 1962. So you can look at periods where we had an inverted yield curve, right? And we're going to talk about the track record here of the 3-month and the 10-year yield. Right now, you can see that it's inverted. And why do we know it's inverted? It's because it's below zero. When it goes below zero, it means the short end of the curve is offering up a higher yield than the long end of the curve you're comparing it to, right? So it went below zero back in October of 2022. So it's been about 1 year. It's been about 1 year since the 3-month and the 10-year inverted. But you can see that there is potentially an uninversion process going on right now. Now, it's too early to say if this move will lead to the immediate uninversion. There are prior examples, like in 1976 or so, where we moved up some, but then we just sort of came right back down, and we did not get that inversion right away, or the uninversion right away. So we must be aware that something like that could happen as well, and that you don't necessarily see the uninversion immediately. And why would that be? Well, again, during periods of high inflation, the reaction function by the Federal Reserve can often be quite different than what it is during periods of low inflation. It's like when this part of the cycle started back in early 2022 and the S&P started to show weakness, a lot of people did not think that the Fed would go anywhere near the rates that they're at today, right? We said back then we would likely go to 5.5% potentially for the terminal rate, even though back then it was seen as absurd, an absurd idea. That is where we went. And the reason we went there is because the reaction function by the Fed during periods of high inflation is very different than what it's been for the last 40 years. So a lot of us, including myself, right, we haven't really lived through periods of high inflation other than the period we're currently in right now. So in order to understand the reaction function by the Fed, we have to look at the context of history to say, all right, well, what does the Fed normally do when we have inflation this high? And to do that, you'd have to go back to the 1970s or you'd have to go back to the 1940s, okay? But what you'll see is that time and time again, anytime there is an inversion of the 3-month and the 10-year yield, it leads to a recession, right? It happened in 2019 and 2020. You might argue that the pandemic sort of forced that recession in. I'm not going to get in an argument about that. I see the arguments for both sides. The point is to say that we had an inverted yield curve and we had a recession, right? There's always going to be a narrative we can put forward to sort of explain why. And had we not had the pandemic, it's always possible that maybe we wouldn't have a recession, or perhaps there would have been some other event that would have pushed us into a recession. So there's no way to know, right? So it's kind of pointless to spend a lot of time debating about it. There's no way to know. If you go back to the prior business cycle, we had an inversion. Upon the uninversion, we had a recession. The cycle before that, we had an inversion. Upon the uninversion, we had a recession. Same thing in 1990, right? We had an inversion in 89 and then a recession in 1990. And then if you go back to the 80s, you can see we had inversions and recessions. Back over here in the 80s, the recessions occurred before the uninversion of the yield curve. And again, the reason is because Volcker came in and said, all right, we got to do what we got to do to squash inflation. And basically, they induced two recessions back to back to basically kill off inflation, or at least high inflation once and for all, after we just spent a decade dealing with it. Okay. So 1970s, right? You can see inverted yield curve, recession, inverted yield curve, recession, both of which the recession occurred before the uninversion of the yield curve. And this is why I've said before, right? Like, in recent history, the recession normally occurs after the uninversion of the yield curve. But we know that in periods of high inflation, the recession could occur while the yield curve is still inverted. And the reason being that the Fed's reaction function is a lot different. And they might not be as quick to pivot as they have for the last few business cycles, just simply because inflation is more of a factor this business cycle than it was for the last few business cycles. But there is a nuance to the uninversion, the potential uninversion process going on right now. Again, we don't know if this move here is going to immediately lead to the uninversion or not. But the key thing to note is there's two ways that that the spread sort of typically narrows. You can have bear steepeners or you can have bull steepeners. Okay, so a bull steepener is what's not happening right now. Okay, so a bull steepener is when the spread is decreasing because the short end of the curve is going down, right? So when the short end of the curve is going down. So to give you an example of what I mean, let's perhaps go back to 2007. Okay, and what you'll see here is look at where the Treasury yield curve is here, 5.2%. Down here, it's at 4.7. Now let's go forward a little bit, right? We just barely moved forward, and you can see that the short end of the curve started to drop. Right now, it's down at 4.8%, 4.8%, right? 5%, 5%, 5%. Whereas just a few months before, the short end of the curve was, above at least earlier. The 1 month was at like 5.2%, and these were above 5%. But then as you go forward, the short end starts to really drop, and just a few months later, you can see the short end of the curve is now between 3 to 4%. Right? The long end of the curve is still around 5%. So let's roll it back again. Inverted yield curve here. Sorry, inverted yield curve here, where the long end of the curve is between 4 to 5%. This is in March of 2007. Short end, about 5 to 5.2. Long end, 4.5, approximately 4.5 or so. That was in March. Now go to November. You have the long end of the curve at around 5%. So it sort of moved up a little, but the short end of the curve has dropped considerably, right? Down to around 4%. So what happened? We had an inverted yield curve. We saw the uninversion process take place, but it was because the short end of the curve went down, right? The shorter duration treasuries went down. They went down because the bond market started to sniff out a Fed pivot, right? And if the Fed's going to pivot, right, if they're going to lower rates, then you're not going to get, high, you're not going to see those same short-term rates, right? So like if rates are at 5%, but then the bond market now thinks, oh, well, the Fed broke something, they're going to have to cut rates, then the short end of the curve will start to go down, right? The short end of the curve, the yields will go down because they're expecting the Fed's going to pivot, and therefore it goes down. That is known as a bull steepener. One of the reasons I believe and I could be wrong about this, but one of the reasons I think it's called a bull steepener, if memory serves me correct, is that it's seen like as if the Fed is cutting interest rates, then it's seen as bullish for the economy. Now, in the short term, it might not be bullish for the stock market because oftentimes after a Fed pivot, that's where you see significant losses in the stock market. But the reason for that is because it normally takes the Fed breaking something to induce a pivot in the first place, right? They have to break something first. Like, I mean, what are the chances that Powell just comes out next week and says, hey guys, we're going to cut rates? If everything is fine and we still have, inflation at 3 to 4%, like that's not very likely going to happen. It could happen if they broke something and the S&P dropped, was starting to drop considerably. And then it can still drop until, close to the last rate cut. But it's called a bull steepener, I believe, because sort of it implies that, okay, we have lower interest rates coming, and therefore it's bullish for the economy. In the short term, it might not be bullish for the stock market, but over a longer time period, shorter or lower interest rates are bullish for the economy because, the cost to borrow goes down. But what we're seeing right now is not a bull steepener. We're seeing a bear steepener. A bear steepener is when the long end of the curve goes up and the short end of the curve, could be staying flat, right? The spread is narrowing because the long end of the curve is moving, not the short end of the curve. The short end of the curve is staying relatively constant, right? I mean, we're at 5.5% now, and the short end of the curve was also around 5.5% back in June, right? The long end of the curve back in June was 3.5%. Now the long end of the curve is near 4.5% to 5%. So this is known as a bear steepener. So it's different. And the reason it's called a bear steepener is because the long end of the curve is going up, right? So it's basically saying, okay, well, the cost to borrow is going to go higher. That doesn't mean that the long end of the curve on its own will lead to the uninversion of the yield curve, although it's possible. It's possible that something like that could occur. If the long end of the yield curve were to go, say, up above 5.5%, then this would uninvert, right? If it were to go above 5.5%, then we would see the uninversion of the yield curve. There's a counterpoint, though, as well, and that is that as businesses start to recognize that longer-term treasuries, the rates are going up, and they start to think, okay, well, the cost to borrow is going to be higher for longer. What they might do to prepare for that is to start to cut costs, right? To try to reduce expenses because they can see that we're going into sort of a new, sort of a new paradigm, or sort of a new normal, if you will, in terms of interest rates. That can then lead these businesses to cut expenses. But if they do that, that could lead to a slowdown in the economy. And if we get a slowdown in the economy, that could lead to a recession. And if it leads to a recession, then what happens is the short end of the curve goes down because the Fed starts to cut to combat all the damage they've done, right? So all the damage they've done over, however long period of time, however long they've been raising rates, they seek to undo some of it by going back to a little bit looser monetary policy to sort of stimulate again, and maybe going, back to QE as well. But that's not, we're not seeing that yet. Right now, we're seeing the long end of the curve, we've been watching it go up, while the short end of the curve has stayed flat. So this is known as a bear steepener, not a bull steepener. A bull steepener would occur if at some point later on, the short end of the curve goes down, leading to the uninversion process. And the reason it would be called a bull steepener again is because lower interest rates would imply that it's long-term, it's more so bullish for the economy, even if the stock market disagrees in the short term, okay? So that, I think, is an important nuance to what's going on right now with the yield curve. I would like to point out a few different things here. You can see that it has a pretty good track record, right? Inversion, recession, right? It happens quite frequently. You can look there's a period in 1998 where we saw an inversion and then we didn't really get an immediate recession. But this inversion did not really last that long, right? I mean, you're literally talking about just a blip below it and then it was just right back above it. The other time where you might note that a recession did not occur was back in, at least not immediately, it was back in 1966, right? So we had an inverted yield curve over here in 1966. It inverted in September, and then it uninverted. So this was September of 1966, and then it uninverted in January of 1967. So it was just a few months, right? It wasn't very long, and we did not get an immediate recession. Now, what's interesting is even though we did not get an immediate recession, we still ended up putting in a new low the following business cycle, and then we put in another new low the business cycle after that. So even in the case where it did not lead to an immediate recession, we still eventually got new lows, right? And also, I would point out that the inversion over here was, negative, it wasn't as bad, right? It was negative 0.42% or so. The inversion over here has been a lot more severe, right? Negative 1.89% or so, right? So it's a lot more inverted today than it really ever was back in 1966. So when you look at this chart, it's always important to note that the uninversion process and after the uninversion process, that is where the recession risk is the highest, right? And if you think about it, a lot of people they look at the yield curve and they say, well, it means recession now. Once you see the inversion of the yield curve, right? So like think back to October of 2022 when we got the inversion of the yield curve, or at least the 3-month of the 10-year. It leads a lot of people to say, well, that means recession now. But it doesn't normally mean that, right? I mean, normally when you get the inversion of it, it doesn't mean recession now. It means recession later, potentially after the uninversion or during the uninversion process. During the inversion process, it typically does not mean recession now. And it didn't mean that this time either. So I think the hard part is that, and Powell has said this himself, right? I mean, interest rates, they sort of induce long and variable lags. So we don't exactly know, how long it takes or how it filters through the economy exactly. But the issue is that we get all these interest rate hikes and then nothing happens. And then people sort of feel this false sense of security, like, all right, well, we survived the rate hikes, right? We're at 5.5% and nothing bad has happened, right? The S&P is still at 4,200 and, we can all just go on our merry way. And then what happens normally is then we then go into a recession, right? And so that is sort of the thing that we have to consider, is that this is a common occurrence, right? It doesn't, when you get the inversion, it doesn't always mean recession now, right? Look at this. This was inversion in July 2006, uninversion May or June of 2007. So you're talking about a year. And then the recession didn't occur until November of 2007. So it's a process, right? It's a pretty long process. If you were to look at the spread on the 2-year and the 10-year, you'll see a very similar story, right? Inversion, recession. Inversion, this was a very, very small inversion here, but inversion nonetheless, right? But inversion, recession, inversion before the dot-com recession, so on and so forth, right? 1989, inversion, recession. 1979, inversion, recession, and 1980, 1981, right? Inversion, recession. So a lot of people, especially, people that are millennials, right? We haven't really experienced the full business cycle. I mean, that's just how it is. It's not our fault necessarily. I mean, our biggest, as I said in the last video, our biggest mistake was that a lot of us were only 10 years old when the dot-com crash occurred. So we weren't able to take advantage of those really cheap stock prices, or, we weren't able to buy a house during the financial crisis because we were still in high school, right? We haven't really experienced a full business cycle, have we? When you look at this chart, can you say we really have? I mean, yeah, we did have the, what happened in 2020, but when's the last time the 2-year and the 10-year was inverted, for a sustained period of time? The financial crisis. That was, you're talking about 15 years ago. 15 years ago. It's a long time. I can tell who my audience is on YouTube. It shows me the statistics. And I know a lot of us were not, we were not adults back in 2006. We were in high school. Okay? So the business cycle that you can see sort of play out time and time again, that's not something we've experienced. So I would not write off this stuff just because of long and variable lags. We must understand that it normally takes a long period of time for interest rates to filter through to the economy. That doesn't mean recession now. It means that the risk starts to materialize. Okay? So we need to consider that as we sort of approach this. So what I would look for over the coming, weeks and months is, where does the long end of the curve go, right? Does it continue to go up? If it does it go above the short end of the curve? There's always a possibility that the Fed hikes again, although I don't necessarily think that needs to happen. I think they've likely reached sufficiently restrictive territory. I think they have. I think the hard part is, how long can they hold it here? It's possible they hike another 25 basis points again, but I don't really think they need to. So, you might see the short end of the curve go up a little bit more if the Fed decides to hike, but the long end of the curve, I think, is what's more so important to look at right now. And remember, the Fed's reaction function is going to be different during an inflationary business cycle than it might be in a business cycle where inflation is relatively low. And the other thing that I'd like to sort of look at just for a moment, or at least a few minutes, because I think we've mostly covered the yield curve and what I wanted to discuss, but and we did a little bit of this in the last video, but I do want to talk a little bit more about it because I left off some metrics that I meant to cover. And what I want to look at is ROI to low after yield curve inversion. Okay, now this is the S&P, and maybe we can at least start with that. This is the current cycle, 2022 to 2023. There's other inflationary periods that we can compare to. So this is not the S&P ROI after, from the peak or anything like that. It's just after the inversion of the 3-month and the 10-year yield. This is what the S&P 500 looks like so far this business cycle. If we can look at 2019, but that's what it looks like. That's what after the inversion in 2019 looked like, right? Climbs the wall of worry until the unemployment rate goes up, and then it drops. Now look at the financial crisis. What was the S&P doing? It climbed the wall of worry until eventually we had the major collapse, and the S&P eventually rolled over. And I mean, look how long this took. We're currently on day, like 340s and the 340s, maybe 344, 345 since yield curve inversion. In the financial crisis, you can see what the S&P was doing around this time. It was sort of in a topping process, right? A long topping process, but it did eventually resolve to the downside. Look at the dot-com crash. It was almost immediately down. Here's some other ones just to throw them up on the screen. I'm going to go through them quickly. If you want to look at them closer, you can pause the video, or you can sign up into the Cryptoverse Premium and look at this yourself. But 1981 to 1982 compared to the current cycle. Here's 1979 to 1980. Look at that. One of the reasons why a lot of these analogs look very similar is because the S&P loves climbing the wall of worry, right? So if you overlay enough cycles where we just sort of slowly trend up until the unemployment rate breaks or the unemployment rate goes up, you'll see it just sort of climb the wall of worry until it gets that major drop. 1974. Here's one, 1973. Right, look at it, climbing the wall of worry, and then it drops, and so on and so forth, right, and so on and so forth. So you can see what I'm talking about when we sort of mention this is what it looks like after yield curve inversion. But what's more interesting to me at this point is not the S&P 500. I mean, it is, like, I do care about it, but I really like following these other metrics. And here's some interesting ones. Here is manufacturing, real manufacturing and trade industry sales. So what we're looking at is we're comparing this metric, real manufacturing and trade industry sales, ROI to low after inversion of the 10-year and the 3-month yield. And this is what it looks like, right? So the yellow dots you see on each line are when the yield curve became uninverted, right? So just to compare some, this is the current one, right? Kind of all over the place. What did the financial crisis look like if we were to overlay it? That's what it looked like in the financial crisis, right? So, and you can see in the financial crisis, this is where you can see where it actually uninverted. It was, right here on the chart, right? Month 10 months after. This is what this metric looked like after the dot-com crash. This is 1989 to 1991. Right, so you can look at a lot of these, and we know, like, people say, well, the economy is resilient, the labor market is resilient, and while that's true, it's true, it is resilient, but real manufacturing and trade industry sales have been resilient in other cycles as well. It's not that this time is different, it's that this time is the same. This is normally what happens because, again, higher interest rates do not immediately affect the economy. It takes time for them to filter through, and then at some point you reach this level where they've actually had their effect, and then the labor market sort of fades. Okay, and then that's when the Fed is forced to pivot. Here's just a few more to throw on the screen just so you can see them. This is 1979 to 1980, right? So it kind of holds on for a time, and then it fades. 1974 to 1975, 1973, 1969 to 1970. So that's one. But there's, of course, many other ones that we could look at as well. And I don't really have, any other specific ones. I think I was looking at this one, advanced sales for retail, trade, and food service. I know it's a mouthful. Let me hide the 2019 one because it kind of throws it off. So right now, I mean, and again, some of the times we don't have as much data. Like this only goes back to the dot-com crash or the financial crisis because it just, we weren't tracking all this stuff, back in the 1960s like we are today. So we just don't have that same data. But again, I mean, like at this point, it's actually tracking what was going on after the inversion back in 2006. Okay, so 2006, 2007, 2008, this is what was actually happening to this metric during that time. And you can see it actually took a long time for it to really fall off this cliff. So right now, this is, month 9, month 10. It didn't really fall off until, month 24, right? I mean, you're talking another year before it actually fell off. But even during that time, it's not like the S&P was going up. It was just sort of topping out. It was just kind of sideways for that year, and then it eventually fell. It's not that it really went anywhere. It just got stagnant for a long time, and then eventually the market faded as the unemployment rate went up. We could maybe look at a couple others. We have been going for a little while now, so I don't want to go too much longer because I imagine you probably want to go do something else. Let's look at the Coincident Economic Activity Index, okay, and compare that to prior cycles. This is what it looks like, right? And what is it tracking the closest with? The financial crisis, in fact, right? This light blue line up here, that's the financial crisis. This orange line, this is 2022, that's the current cycle, right? That's what it's tracking the closest right now. So it's interesting, right? It's interesting how it's not like you can't look at it and say this time is different. It's like this time is actually playing out exactly how one of the prior cycles played out on some metrics. And, if you look through enough of these metrics, you'll find some that are more bullish than they previously have been. I believe maybe real personal income, excluding transfer receipts this time, is it's a bit higher than most of them, but it's actually coming in lower than the one that led into the financial crisis, right? So this blue line over here is 2022. I think the hard part is patience, right? Like seeing it play out and also kind of being under the understanding that there still is no guarantee, right? You could have an uninversion process and it does not necessarily lead to a recession, just like we saw back in 1966. With that said, in 1966, the inversion was relatively light and short-lived, and we still ended up seeing new lows on the S&P 500. Eventually, we just had to wait another, couple of years or so, but it did eventually come. So, I mean, you could spend hours going through this stuff, right? I mean, like, and by the way, I mean, you can get access to this stuff through the website. The link's in the description below, but maybe delinquency rates. I don't think delinquency rates have really gone. They haven't really made a significant move yet this cycle. Maybe real GDP is an interesting one to look at because this cycle we know it's been going up, right? You can see that that's actually above all the prior ones, right? You can see that. Let me hide 2019 because it really throws. So that's what it currently looks like, real GDP after inversion of the 3-month and the 10-year yield. Imports of goods and services, look at this cycle, right? It's going down, and it's actually tracking. The closest one that's tracking is the dot-com crash, right? This is 2000. So imports of goods and services, ROI to low after inversion of 3-month and 10-year yield is actually tracking the dot-com crash the closest. And if we were to compare this cycle to, say, the financial crisis, during the financial crisis, it was going up, right? Now it's going down, more similar to what happened in the dot-com crash. And in fact, this cycle, imports of goods and services, is below where we were in the dot-com crash, interestingly enough. Exports of goods and services, why don't we check that one out? So this is the current cycle. This is comparing it to the financial crisis, right? Well below it. Here it is compared to the dot-com crash. We're below where we were in the dot-com crash. So you can go through a lot of these metrics and see that, like, in some metrics, we're outperforming prior cycles. In other metrics, we're underperforming prior cycles. So it's interesting, right? It's interesting to track. One of the things that is notable is that the money supply in this cycle is the only time it's really gone down, right? So, like, at least in recent history, ROI to low after yield curve inversion. You don't see anything for all these other business cycles. Why is that? Because the money supply didn't go down, right? It went up. This is the only cycle in recent history where after yield curve inversion, we saw the unemployment rate, or sorry, we saw M2, the money supply, go down. So that's sort of, throwing a wrench into it that we didn't even really get in prior cycles. So that's sort of a nuance of this cycle that is sort of outside of what we've historically seen. If you were to look at what other stuff could we look at? Net percentage of banks tightening loan standards. This is the current cycle. Here's the financial crisis days is not even out. Here's the .com crash, right? So we're kind of right where we were in the .com crash at this point. The issue with crypto is that it hasn't experienced this before, right? Like it's so hard to know. I mean, we can take our bets, right? I mean, I've been very, very bearish on altcoins forever because we see all this QT going on, and we know that altcoins only thrive when there's excess liquidity. And when you're in a period like we're in right now, it doesn't mean you're not going to get sizable rallies occasionally, but the expectation is that it likely just leads to lower highs because liquidity is still drying up. And if liquidity continues to dry up, then it likely means lower highs. It doesn't mean there can't be rallies, right? I mean, there's going to be, but it normally just means that it'll just simply be a lower high. So I think we should probably go ahead and wrap it up because we've been going on here a little while now. But I just wanted to give you guys, sort of provide a discussion on the yield curve to kind of show where we are. It is still very much inverted. The long end of the yield curve has gone up. That's known as a bear steepener. If eventually the short end goes down, that would be known as a bull steepener. But that's not what we're looking at right now. Right now, we're in a bear steepener as the economy is sort of adjusting to higher rates, And how long has Powell said that this is what's going to happen, that they're going to go higher for longer? How long has he said it? I do think the Fed will pivot, right? I mean, I don't know when. If I had to guess, I would say 2024. But if the S&P 500 were to pull off a 1987 on us and drop 20 or 30%, then they probably would pivot sooner. But that probably shouldn't be the base expectation, but certainly an expectation to be at least aware of. I think the base case is the Fed's going to try to keep rates as high, as high as they can for as long as they can. And so, part of the reason why the long end has gone up is because the market is sort of accepting that the economy can handle higher rates. Because if it couldn't have handled higher rates, then that would have shown up already, or at least that's what the market is saying, right? But then once the market prices in all this stuff and the market starts to believe higher for longer, that's when businesses have to adjust. And if businesses have to adjust, that can lead to a slowdown in economic activity, inducing a recession, which would then potentially cause a bull steepener where the short end goes down, the Fed is forced to pivot, the stock market sells off, and then bottoms on rate cuts, and then we start a new business cycle. I think we'll wrap it up there. Again, if you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. And again, check out the website that we've been showing here at intothecryptoverse.com. I know it's called Into the Cryptoverse, but we actually have a ton of stuff on macro, as you can see. We also have a ton of stuff on equities. And we've actually recently added in a macro dashboard where it actually shows sort of, you can look at when things are updating and sort of sorted by, all right, well, what is the last thing to update? Okay, Fed total assets. We get that every single week. Initial claims, right? And that's something we've tracked, right? And that's the reason why it's not really recessionary territory just yet, because initial claims are all the way down here. I will caution you and say that last year, initial claims bottomed out in September. And so far, initial claims have bottomed out in September, but we'll see if it continues to go up or not. It has gone up here the last couple of weeks, but that is something to look at. And so as long as the labor market remains this tight, the Fed's probably not going to pivot. But if it starts to show more signs of weakness, then certainly that could happen. We'll wrap it up there. Thank you guys for tuning in. Subscribe, give the video a thumbs up. I'll see you guys next time. Bye.